In this video, today we will talk about WTF do investment bankers actually do? Investment bankers have a reputation for making big money, wearing sharp suits, and working grueling hours. But what exactly do they do to earn those high salaries? The world of investment banking can seem mysterious, shrouded in complex jargon, and deals made behind closed doors. However, at its core, investment banking is about facilitating the flow of capital between businesses and investors, helping companies raise money, grow, and restructure. Let's break down the role of an investment banker and what their day-to-day work actually involves. 1. Facilitating capital raising, debt and equity financing. One of the primary roles of investment bankers is to help companies raise capital. This can be done through two main channels: equity financing and debt financing. Equity financing. This involves helping companies issue shares of stock to investors. When companies want to go public, in an initial public offering, or IPO, investment bankers play a critical role. They guide the company through the entire process, from preparing the financials to marketing the shares to investors. Debt financing. Investment bankers also help companies raise money through debt, typically by issuing bonds. The bank advises on how much debt a company can safely take on and at what terms, and then helps sell those bonds to investors like pension funds, mutual funds, and other institutions. In both cases, investment bankers act as intermediaries between the company looking for money and the investors willing to provide it. They ensure that both sides get the best possible deal and that the process runs smoothly. 2. Advising on mergers and acquisitions, M&A. Investment bankers are heavily involved in the world of mergers and acquisitions, where companies either buy other companies, acquisition, or merge with them. This can be a complex and high-stakes process, and investment bankers are crucial in making sure everything goes as planned. Sell-side M&A. On the flip side, when a company wants to sell itself or one of its divisions, investment bankers help position the company for sale. This involves preparing detailed financial analyses, marketing the company to potential buyers, and negotiating the best possible deal. These transactions often involve billions of dollars, and the stakes are incredibly high. Investment bankers help navigate this complex landscape, ensuring that their clients get the best deal and that the transaction is completed without legal or financial complications. 3. Advising on restructuring and bankruptcy. When companies hit hard times financially, investment bankers can step in to help them restructure their debt or manage a bankruptcy. This can involve renegotiating the terms of loans, selling off parts of the business, or advising on how to downsize operations to cut costs. Investment bankers work closely with distressed companies to make sure they can continue operating while managing their debts. In cases of bankruptcy, investment bankers might help liquidate assets or sell the company to a buyer willing to take on the troubled business. 4. Valuation and strategic advice. Beyond just raising money or facilitating deals, investment bankers provide strategic advice to companies on a range of financial matters. One of their key services is valuation, where they help determine how much a company or asset is worth. This is essential for M&A deals, IPOs, or even internal corporate decision-making. Investment bankers use a range of techniques to value companies, including analyzing financial statements, looking at comparable companies, and using sophisticated financial models. Their job is to provide an objective, well-informed estimate of what a company is worth and how different business decisions might affect its value. 5. Underwriting and risk management. Investment bankers also take on the role of underwriters when companies raise capital, particularly during IPOs or when issuing bonds. Underwriting means that the investment bank guarantees to buy a certain amount of the securities, stocks, or bonds that the company is issuing, essentially taking on the risk that they might not sell. In this scenario, the investment bank buys the securities from the company and then sells them to investors. If the market doesn't respond well and the securities don't sell at the expected price, the investment bank could lose money, which makes this a risky but potentially lucrative part of the business. 6. Creating complex financial models. Investment bankers spend a lot of time building complex financial models to evaluate potential deals, investments, or restructuring efforts. These models are used to predict future financial performance under different scenarios, allowing bankers and their clients to make informed decisions. Investment banking analysts, in particular, spend many hours perfecting these models, which are critical tools for deal-making and strategic planning. 7. Pitching and business development. A big part of the job for investment bankers is pitching new business to clients. Investment banks are always on the lookout for new deals, whether it's a company looking to go public, a business wanting to expand, or a potential merger. Bankers regularly meet with CEOs, CFOs, and boards of directors to pitch ideas and showcase how the bank can help them achieve their goals. Pitching involves preparing presentations, financial analyses, and reports to show the client how a specific transaction could benefit them. This is a highly competitive part of the business. Investment banks are constantly vying for clients, and securing a deal can mean millions of dollars in fees. 8. Handling regulatory and legal issues. Given the high stakes and complexity of many investment banking deals, there are often significant regulatory and legal issues to navigate. Investment bankers work closely with legal teams to ensure that all transactions comply with local laws, international regulations, and industry standards. For example, IPOs must adhere to strict rules set by the Securities and Exchange Commission, SEC. And mergers often need to be approved by regulatory bodies to ensure that they don't violate antitrust laws. Investment bankers help steer their clients through this regulatory maze, ensuring that deals can go forward without legal roadblocks. 9. Earning massive fees. Investment bankers are compensated based on the size and complexity of the deals they facilitate. The larger the deal, the more money the investment bank makes. For example, an IPO or an M&A deal worth billions can generate millions in fees for the bank. This is why investment bankers are some of the highest paid professionals in the financial world. Their fees are typically structured as a percentage of the total deal size, and this can range from a fraction of a percent on massive deals to a higher percentage on smaller transactions. For companies raising capital, the investment banker's fee might seem high, but the value of their expertise and ability to close deals often justifies the cost. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.